Hi, this is Eric Boyce, Chief Investment Officer and CEO for BKA Wealth Consulting. Appreciate you joining us here on April 27th of 2020. This is another one of our installments in our attempts to provide some information to you, our client, and to our the BKA friends and family in our community. I've got a little bit of data here. Actually, I've got a lot of data, but and also have some observations as things have developed over the last week. Now over the last week, we began to see some announcements about some of the states and regions actually beginning to open their economies again. So that's a little bit of both a trepidation as well as a source of optimism, depending on how you look at it. So we're at a little bit of a crossroads, even as the data begins to come in fairly negative for April and for some of the high frequency data here that we're beginning to see for the second quarter. But just to kind of jump into it, last week, the Dow Jones index was down almost 2%. S&P 500 was down about 1.3. NASDAQ was barely flat, slightly below. Actually, since March 23rd, the S&P 500 is up almost 27%. Most of that gain it seems like it's been concentrated in some of those technology stocks that have been really fast out of the barn. Like Facebook and Amazon, Google, Apple, some of those have been very strong. And in fact, those stocks now, according to some work by Sandy Leeds at UT, now represent about 20% of the S&P 500. So the S&P now is down 16% from its peak, despite everything that's going on. And it's actually on pace to have one of its best months in about 9 years. So headlines last week, obviously we've got the unemployment numbers. We'll talk about that in a second. Retail bankruptcies and some other data, corporate earnings beginning to come in bad. And also we've got more rhetoric with regard to suspensions of dividends and obviously repurchase data. And we've got some information on that as well. Interest rates continue to be fairly low. 10-year yield, the 10-year Treasury yield is about 0.6%. But so far, we haven't really seen a lot of the credit markets tighten up like you might ordinarily see in this environment. So we've got a lot of liquidity in the system. We'll talk about that. We've got a lot of eager lenders out there trying to get the stimulus out into the community. So far, we haven't seen a lot of major credit allocation and credit access. Businesses being able to access credit. We haven't seen too many of those choke points just yet. In the overall economy, we've seen the biggest monthly drop in the index of leading economic indicators in almost 20 years. And then we've got, obviously a huge drop in commercial flights. New business formation is down about 30% year over year. And then in the real estate markets, we've got leasing activity for office space down at least a third. And then we've got it somewhere on the order of 10 to 15% of tenants in apartment buildings have missed their rent payments. So you're beginning to see that stress kind of manifest itself in the data a little bit. With regard to the equity markets, we've had, as I mentioned before, we've had kind of a difference in activity and difference in action, if you will, on the part of tech stocks versus the rest of the market. And also, as I mentioned in the last installment of this, that large caps have fared a lot better than small caps. So right now, so the NASDAQ, which is really more tech related, has done very well, and it's outperformed small caps. And the drop in earnings for small caps is approximately 2 times as high as the drop in earnings for large caps. And then firms with strong balance sheets over the last couple of months have outperformed firms with weaker balance sheets or financial condition by somewhere on the order of 20%. So we've seen a significant rotation into higher quality and also large cap, which really mimics what we've done in our own portfolios. U.S. is now 55% of the world's equity market capitalization. And the other thing that was interesting that was noted by Sandy in his weekly update was that venture capital and private equity funds both have amassed a lot of liquidity and are poised to be consolidating these enterprises that come out of this with some degree of difficulty, or those struggling enterprises that need capital infusions, that these funds are ready to come in and perhaps consolidate some of these enterprises coming out of this coronavirus affair. Stocks in general are kind of really stuck in the middle. So on the one side, we've got over $5 trillion of monetary policy stimulus, and then we've got $3 trillion worth of fiscal stimulus, which we know is going to go up. So there's kind of almost a tug of war between those two. So obviously the markets are reacting positively on balance this month. Market values the liquidity that's being provided by the market quite heavily. And I think it's, in terms of equity market behavior, it's leaning on that a little bit more right now than it is, on the fundamentals, which are clearly bad. And we'll talk about that in a second. But, so a little bit of a tug of war. I think that adds to the volatility that we should expect near term. And what it means is that, in some days the market will tend to focus on the bad economic and company data that we're going to be getting. In some days it's going to value the fact that we've got a backstop of unlimited stimulus coming from the Fed, the unlimited ability for the U.S. to create money to throw at this coronavirus problem, and we'll get some uplift in from time to time from positive news flow as well. So just suffice it to say, it's going to be a bit of a tug of war for the time being. In the bond market, in the last couple of recessions, credit markets have recovered a lot faster than equity markets. In fact, in 2001, work by Sandy leads, the recovery was 10 months versus 81 months for the equity market. And in 2009, it was 15 months versus 65 months for the equity market. So we have, high yield spreads have come in quite a bit. So those rates are not nearly as high as they were before the Fed came in and said that they are probably going to be buying some high yield paper. But we've, there are some dynamics going on in the fixed income market that we need to watch. Obviously, the credit quality and how that transpires over the next several months, and that the degree that more companies are issuing negative outlooks, and the risk of those rating downgrades, and the risk of some of the investment grade paper or the investment grade bonds being relegated to junk is also something that we need to monitor as well. But just moving on, just looking at both monetary policy and fiscal policy, we're seeing a continuation of more fiscal stimulus by our government. The package that was approved last week was about $480 billion, $370 billion for small businesses, another $100 billion for healthcare and testing funding. So that brings the total to date to about $3 trillion. And we know that state and local governments are struggling with tax receipts and their own revenue issues. And so we expect another package, albeit controversially, at some point in the next couple of months. And I anticipate that the political rhetoric will just continue to increase with that. So our fiscal deficit has increased from $1 trillion to now about $3.7 trillion, which is 18% of our economy. And by comparison, even back in the financial crisis of 2009, that was only slightly less than 10%. But 18% deficit right now still is far below the nearly 30% deficit that we ran back at the heart of World War II. We know that the Fed balance sheet is about approaching $7 trillion now. And as a percent of GDP, it's 30%. Um, the Fed, that being the amount of debt and the assets that the Fed owns, is about 30% of GDP. And we do know that money supply, as a result of some of this monetary injection, is up quite a bit. In fact, money supply over the last year is up 15%, which is a record. And money is being transferred from government accounts directly into individual accounts by virtue of the stimulus programs that are outstanding. And then on the fiscal side, as I mentioned, the budget deficit's approaching 20% of GDP, and we'll have basically the publicly held treasury debt will more than likely reach 100% of our economy in the last couple of years. And that's something that we were watching very closely about 11 years ago, coming out of the recession. So we've seen a lot of very hard and fast response from both the government as well as the Federal Reserve. Unemployment, we know it's continuing to go higher. We saw, let's see, the overall unemployment level, as it's going to shake out, it's probably going to be closer to 15 to 20%. We just don't know. But the weekly claims data comes out on Thursdays. The peak in that data was almost 7 million new unemployment insurance claims on the week of March 28th. And that's dropped 3 weeks in a row. And we're just beginning to see, as those initial claims translate into continuing claims, that's likely to rise and peak sometime probably in June. But when we see a transition in continuing claims, when they crest and begin to roll over, that's when we can kind of begin to peg perhaps a bottom of this recession. So we're going to be watching that very closely as well. So so just another study that I looked at this week. In the first 2 weeks of April, 25% of workers said it is either very likely or fairly likely that they will lose their job or be laid off in the next 12 months. And 48% said that if stay-at-home orders were lifted, that they wouldn't go back unless the outbreak was over. 39 said it depends on the outbreak, and 13 said that they would return regardless, which is interesting that Sandy published this last week in his update. So on unemployment, moving to corporate earnings right now, we've got with about a quarter of the companies reporting in the S&P 500 reporting their earnings. It looks like the data is tracking about down 15% year over year. That means earnings from last year to this year for the first quarter of this year are down 15%. We think that might drop a little bit more by the time that the other 3/4 of the companies in the index report. So that might be down somewhere between 20 and 25%. As you might expect, second quarter is tracking anywhere between -30 and 50% down. And then I think we're still going to see down earnings for the third and the fourth quarter before that trends positive next year. Third quarter may be down something like 15 to 20%, and the fourth quarter may be down something closer to 5 to 10, but obviously getting better, but still negative nonetheless. And as you can imagine, if you have had to wait in any kind of a line at your supermarket, that some of the consumer staples, consumer communications type companies, healthcare technology companies, utilities are flat to slightly up. And most of the pain in the market in terms of earnings has been felt by energy, consumer, discretionary type spending, and industrials and materials entities where activity has really just been curtailed. quite a bit. But so far, the healthcare and technology sectors continue to be fairly well positioned, from by all appearances. Another dynamic that we're following in the S&P 500 is the level of buybacks. So we know that share repurchases by companies that have excess capital have contributed to performance of the index over over a number of years. And last year, S&P 500 companies spent collectively about $700 billion on buybacks, which represented about 2.5% of the market capitalization of the S&P. So over the last 5 years, basically it's added about a percentage point of growth to earnings growth just by taking out more shares that are in that earnings per share calculation. So now we know with the pressure from the slow economy and debt from prior repurchases, and probably with some of the stimulus that some companies are going to get, they're going to be curbs on their ability to buy back shares or even pay dividends in some cases. So we know that we're going to anticipate fewer buybacks. So that's going to put some pressure on the ability of companies to generate better earnings per share and get more capital back out into the shareholder community. So I think that's something that we're clearly anticipating, that fewer buybacks are going to lead to less of an earnings support from those buybacks going forward. So on the oil price side, obviously here recently we've seen oil prices on the near-term contract go negative. That's probably worthy of its own podcast or webcast by itself, but we know that oil is going to remain volatile. There's just no question about it. We've got storage capacity that essentially we're running out of storage capacity, and basically the cuts that have been announced by OPEC and the OPEC affiliated members are not going to be enough to stem the drop in demand that we've seen, where we've seen maybe a 10% cut in overall capacity, or at least agreed to cuts. We've seen almost a 30% drop in the use of oil. And a couple of statistics: 45% of oil is used for vehicles and transportation, and another 8% is used for airplanes and airlines. And so we know that people aren't driving. Airlines are not flying at least nearly as much as they were. So there's that impact that we know. We could be closer to 85% of storage capacity by June, and we're about 80% right now, and we can't really go much higher than that without taking extraordinary measures like using tankers to store crude oil. Typically about 5% of tanker capacity is used for that purpose. Right now it's almost 30%. So you've got people that are trying to store oil in every nook and cranny that they can, because production is not coming offline fast enough. And so, the impact of this, we're going to get shut-ins because the price of crude, at least on today's price, was somewhere around $12 a barrel. We may even have, when the June futures contract comes up, we may have another situation where energy prices or crude prices go negative briefly. But as you can anticipate, the oil or the energy intensive country or states rather, like North Dakota and to some degree New Mexico and Alaska and Oklahoma are going to be impacted. Texas, for its part, has a little bit more of a diversified economy, but nevertheless is going to be impacted by the transitions that are taking place in the energy sector right now. So as I look at it, inflation is another thing that we're kind of paying attention to right now. The debates are waging right now as to are we going to have inflation We didn't see that when we had a lot of stimulus and a lot of liquidity injected in the market 11 years ago. And we've been waiting for it for almost that entire time. This time it's interesting. It's similar in some respects that, empirically you would expect there to be inflation with so much liquidity sloshing around. But, at the same time, I think coming out of this, we're going to find that consumers who represent 70% of the economy are not likely going to be spending as much, meaning that they're going to be saving more. And if you don't have those dollars, in the market, in the economy, multiplying, through purchases and whatnot, that's going to tend to be, less inflationary than if you gave them a whole lot of money and they spent every dollar of it. Now, we know that the consumer price index was down in March at the fastest pace in 5 years. Obviously, that's has a lot to do with the demand shock that we've had, that, we've had a certain level of consumption that's just been basically taken away. But the other thing that could impact long-term inflation, and we'll just have to see how this plays out, is what happens in terms of globalization. Globalization, free trade, cross-border trade, which has gotten a lot of press lately, particularly with companies that do business in China that, like the pharmaceutical industry, that we get a lot of our source material for making pharmaceuticals from China, that there's a risk in having those multilateral trade agreements. But we've seen a gradual trend over the last couple of years during the Trump administration of moving away from free trade and moving away from globalization, and the supply chain hiccups that we've seen out of this COVID-19 issue might accelerate that trend. And I think globalization over the last decade has had a lot to do with the fact that we've had low inflation. So the reversal of that trend, may portend that onshoring, might be an influence to get prices to move a little bit higher. So, but we'll just have to see on that. I would just have to say that, the last thing I wanted to touch on is just kind of like, this whole notion of the economy beginning to reopen, and we're on the very first hour of this. It's been speculated. It's clunky. It's uneven. The governor of Georgia has taken a lot of heat, from some people, and you'd even see President Trump, going back and forth on his either his support for or criticism of the governor for his actions. And I would just say that there's going to be social distancing. There's still going to be disagreements with regard to that. There's going to be kind of differences of opinion on the timing of how you do that, and whether you start with 25% of capacity. What industries do you open? Those are debates that are kind of raging right now. So I think, suffice it to say, it's going to be relatively uneven in terms of how this plays out over the next 2.5 months. We get into the kind of the tail end of June, beginning of July. We'll have a lot more visibility then, but between now and then, it's going to be relatively uneven and inconsistent. And I guess to some degree, probably even controversial, depending on your point of view. So, those things coupled with, as I said, kind of tying this back to this tug of war in our investment markets about, feeling good about having all this stimulus, feeling good that the government is backstopped against the wealth of bad data that we are going to get over the next couple of months. It's going to lead to more volatility. And I think just more continued, speculation. I do feel fairly strongly that we've seen the low, but that doesn't mean that we could give up some of what we've gained since then. But I think the lows in the market have been achieved. I think, probably the bias is that the interest rates are going to remain low for at least the near term. The Fed certainly has an incentive to keep interest rates low, because as we're issuing more Treasury debt and more federal debt that has an interest rate tied to it, the Fed's going to, I think, be motivated to want to keep that interest rate low to place less pressure on our fiscal deficits. But in any case, you'd say that the data is relatively fluid. We're keeping an eye on everything. We're watching these tea leaves. I think there's, you look into 2021, I think there's a much better outlook. So if we can get through this interim period with as much visibility and transparency as possible, I think that there's really some optimistic undertones or underpinnings, if you will, to the market as we get into the fourth quarter and first quarter of next year. And when we see these earnings, year-over-year earnings numbers become less negative, the market become increasingly more positive, and we begin to lapse and anniversary some of this bad data that we're seeing now, then you could see some of this liquidity that's now sloshing around really begin in earnest to come back into the market and give it some sea legs. So stay the course, continue to monitor, and rebalance is kind of our mantra right now. And as always, we want you to please reach out to us if you have any questions, comments, cares, or concerns. There was a lot of data and analysis this week, so the webcast this week was perhaps a little bit longer than usual, but I wanted to get this information out to all of you. And feel free to reach us. You can find us on the web at www.bkawealth.com, or you can reach us at 512-522-4838 or any of our individual email addresses. So I hope you have a wonderful day, a wonderful week. Be safe, and please feel free to reach out.